Hello everyone, I am Rohan Vishwakarma and this video is presented to you by Educare. Guys, the last video on economy was an orientation and just an introductory session. So if you haven't watched our first video on Indian economy, you can go back to the playlist and watch it before starting this one. So today we are starting economy with banking because in our last analysis, we saw that banking is of utmost importance in WBCS, which accounts for 1/4 of the paper in the mains. And this video will also be helpful for those preparing for SSC and Bank Examination. So guys, this is the part 1 of banking. Since banking is a very long chapter, so it was not possible for me to finish in a single video. So I will have to make 2 or 3 more videos to finish this chapter, and that will be uploaded very soon. So guys, before going directly into banking, first let us know about money. Let's go even before money was invented. So before money, we all know that trade was conducted in barter system. Now what is a barter system? Barter system is just an exchange of goods or services between two people. But guys, barter system was possible only if there was double coincidence of wants. Now what is double coincidence of wants? I will explain you with an example here. Look, here is a guy who is cultivating apples, and now this guy needs hen. Now he have to find some other guy who has hen, and he should be willing to exchange that hen for apples. So only in that case trade was possible between these two parties. So this is double coincidence of wants. That means two parties should be willing to exchange each other's produce. Now double coincidence of wants was very rare to find in an economy, so barter system failed. Now why double coincidence of wants failed? For example, if there was, suppose there were many farmers who had hens. What if no one was willing to exchange that hen for apples? So that was the issue of double coincidence of wants. Barter system failed because of double coincidence of wants. This DCOW is an abbreviation for double coincidence of wants. That was one of the issue why the barter system failed. And guys, the another reason why barter system failed was the problem of measurement of value. Now what does this mean? Suppose this guy finds him that who is willing to exchange his hen with apples. Now the next question was, how many apples is worth a hen? That was the biggest question after finding someone who is willing to exchange hen with apples. Now suppose this guy even finds out that so a hen is worth 50 apples. So in the future he may need, suppose he needs a rice in the future. Now the next question would be, how many apples does a kilo of rice is worth? So in that case he still finds that a kilo of rice is worth 20 apples. Now guys, human beings need so many things to maintain livelihood, so it was not possible for a single human brain to know the worth of all the articles that he needs in terms of what he has. So now it was not possible for this guy to know the worth of all the articles in terms of apples. So that was another problem why the barter system failed. So we all know that there was necessity of a common medium of exchange, and since the necessity is the mother of all invention, so people invented money. So guys, now money. What is the money? Money is a medium of money is a medium of exchange, and it is a measure, and it is used as a measure and store of value. Like the evolution of human beings, money also has its own evolution. You can see the chart here. From barter system evolved the coins. Previously it was they used to be clay coins, and later on eventually it evolved to coins. Then it evolved to paper money, then plastic money, then even mobile money like we use today, like Google Pay, Paytms, Phone Pay. And the latest form of money evolution is bitcoins, or the digital currency, virtual currency. So that is the present evolution of money. So guys, you can see an analogy here that the more the economy gets developed, money loses its physical form. because there will be ample scope for cashless transaction. Now the next is money supply. Now what is a money supply? Money supply is the total stock of money in circulation among the public at a particular point of time. Now guys, remember that money supply does not include the money which is held by the banking system and the money which is with the government, because they are money suppliers. And next, measures of money supply. So measure of money supply, there are 5 parameters of money supply in India. These are very important for the exam perspective, because if you go through the previous year paper, question has been asked in the mains from measures of money supply. So there are 5 measures. First is M0. M0 is also called reserve money, which is simply the sum of currency in circulation. Bankers deposit with RBI and other deposits with RBI. And now M0 is also called reserved money. Next is M1. M1 is called narrow money. It is currency with the public, demand deposit with the public bank system, and other deposits with RBI. Next, M2. M2 is M1, narrow money plus saving deposits of post office. Next, M3. M3 is called broad money. It is the sum of M1 plus time deposits with banking system. And lastly, M4. M4 is nothing but M3 plus total deposits with post office savings bank, excluding national savings certificate. Now guys, you have to remember this chart because this is very important. Question has been asked from this measures of money supply. Next is money multiplier. Now what is money multiplier? Money multiplier is the ratio of broad money to reserve money. M3 by M0 is money multiplier. Money supply is very important because the monetary policy, which we study later on this chapter, is all about increasing or decreasing the quantity of money, the money supply. So since there were 2 terms here, demand deposits and time deposits, now let us discuss what these 2 type of deposits mean. We all know that basically bank account, it is divided into 2 parts, two categories. One is demand deposits and another is time deposit account. Now under demand deposit, there are 2 types of accounts, savings account and current account. We all know what savings account is. Now why are these 2 type of account called demand deposit is that this account can be operated according to the demand of the account holder. That means an account holder can withdraw or deposit money in these 2 types of account according to his wish or according to his demand. So I hope it is clear. The current account is nothing but it is same as savings account, but there is little difference. This account is operated by businessmen, and in this account the rate of interest is 0%, that is you won't get any interest. And this account provides you a facility of bank overdraft, which means that you can withdraw money from your account, from your current account, even if your balance is 0. That is, you can have a negative balance. It is just like a short-term loan which is lended by the bank to the businessman, and bank will charge interest on such lending. And now next is term deposit, or term deposit is also called time deposit. Now why is it called time deposit? Now why is it called time deposit is there is time factor involved. And there are 2 types of term deposit. One is a fixed deposit and another is a recurring deposit. Now we all know what fixed deposit is. Fixed deposit is depositing a certain sum of money for a certain period of time. For example, if I deposit 10,000 rupees for 10 years, that is a FD account. So here time factor of 10 years was involved. Similarly, in recurring deposit account, there is also time factor involved. A recurring deposit account means recurring, literal meaning of recur is to happen again. That means you have to deposit money in this account at a certain interval of time, which is prefixed while opening the account. For example, if you deposit rupees 10,000 in your account every month for 10 years, this is an RD account, recurring deposit account. So here also time factor is involved. This is the time factor. So that is why it is called term deposit or time deposit account. So guys, I hope this is clear to you. And next is black money. Black money is nothing but the money which is earned by evading tax, or simply the money in which the income tax return has not been filed. Black money is not very good for an economy since it decreases the money supply. And now next, let's proceed to bank. What is a bank? We all know that a bank is a financial intermediary that accepts deposits and lend loans. Because banks are the steel frame of any economy. It holds top place in the economic structures of our nation. It is a place. It is a place where the capital surplus and capital deficits parties meet at a common ground. It is a financial institution that accepts deposits from customers with capital surpluses and offers loan to client with capital deficits. So bank will accept deposits from the people and they will lend these deposits to businessmen and which help them to set up industries. So these are just pick of some industries, and they will charge higher interest in their lending than the rate of interest which they provide in their to their saving account holders. For example, if they lend, so guys, for example, let's say a bank accepted a deposit of 10,000 from its saving account holders. Now the bank will lend this amount to businessmen, suppose at a rate of 10%. So they will have to pay an interest of rupees 1000 every year. And now what will bank do? The bank will pay interest less than 10% to its saving account holders, for example 8%. So this 2% is the profit of the bank. That is what helps banks survive. And guys, now let us discuss about the history of banking in India. So the history of banking in India dates back to the 18th century. So Bank of Hindustan was the first bank to be established in India. It was established in 1770 under European management of Alexander and Company. So you can see here, this is the bank note which was issued by Bank of Hindustan. And next in the picture comes the Presidency Bank. Presidency banks were established by company government to facilitate their trade in India. So this was the first Presidency Bank, Bengal, established in 1806, and next Bank of Bombay 1840, and next Bank of Madras 1843. So these were the three Presidency banks. So now next, Out Commercial Bank. Out Commercial Bank, this was established in 1881, and this was the first bank to be managed by Indians with limited liability. And next in the picture comes Punjab National Bank. This was the first purely Indian bank which was established on 19th May 1894. And next, those three Presidency banks which was established by the company government was merged on 27 January 1921 to form the Imperial Bank of India. So those three Presidency banks were merged in 1921 to form the Imperial Bank of India. And next is the emergence of SBI. So we know that these three Presidency banks, this was merged to form the Imperial Bank of India, and this Imperial Bank of India was renamed to form the State Bank of India. So the history of State Bank of India starts from 1st July 1955, and presently this is the largest public sector bank of India, which is headquartered at Mumbai, and present chairman is Rajneesh Kumar. And presently State Bank of India has 5 associate banks. So those are State Bank of Travancore, State Bank of Bikaner in Jaipur, State Bank of Mysore, State Bank of Hyderabad, and State Bank of Patiala. So previously there were 7 associate banks of SBI. So State Bank of Saurashtra was merged with SBI in 2008, and State Bank of Indore merged with SBI in 2010. And also remember guys, that Bharatiya Mahila Bank, this was the first bank in India exclusively for women, managed by women. This bank was merged with SBI in 2017. Now next comes the nationalization of banks. So In 1969, 14 commercial banks of India were nationalized. Now, what does nationalization mean? Nationalization means when the government buys private entities and makes it public enterprise, that is called nationalization. Now, it is simply the opposite of privatization. What is privatization? Privatization is when a private sector company buys government entities or organization, that is called privatization. So, privatization and nationalization are opposite to each other. So, on July 1969, 14 commercial banks of India were nationalized. So, let's see those 14 commercial banks. So, Allahabad Bank, Indian Bank, Overseas Bank, Bank of Baroda, Bank of India, Punjab National Bank, Bank of Maharashtra, Syndicate Bank, UCO Bank, Canara Bank, Central Bank, Union Bank, Dena Bank, and United Bank of India. These were the 14 banks that were nationalized on 19th of July 1969. And later in 1980 as well, six more banks were nationalized. And those were Punjab Sindh Bank, Vijaya Bank, Oriental Bank of Commerce, Corporation Bank, and Andhra Bank. There was one more bank called New Bank of India. 6 banks were nationalized in 1980, and this new Bank of India is not here in the picture because this was merged with Punjab National Bank. So New Bank was merged with Punjab National Bank in 1993. So now the number of nationalized bank in India is 19. 14, which is 14 in 1969 plus 5. So total, there are 19 nationalized banks in India as of today. So guys, as we discussed that 14 banks were nationalized in the first phase of nationalization on 19 July 1969. In 1969, those banks having deposits of more than 50 crores were nationalized. And in phase 2 of nationalization, that is in 1980, those banks having deposits more than 200 crore were nationalized. And as I told you earlier that in September 1993, New Bank of India was merged with Punjab National Bank. So the total number of nationalized banks is 19. Now let us know the reasons behind such nationalization of banks. So firstly, the concentration of economic power in a few hands. The economic power was managed only by a few, it was limited to few hands. Secondly, there was private ownership of commercial banks. So if there is private ownership in any sector, their only motive will be profit maximization. So they were neglecting priority sector. Priority sector means they were neglecting the development of agriculture and rural areas. Why were they neglecting? Because those areas were not providing them a good rate of interest. And what changes can we see after nationalization? Firstly, the expansion of number of branches. Now branches were opened after nationalization in the remotest of areas which were previously ignored. Prior to nationalization, those areas were ignored. Next, priority sector lending increased. That means more farmers and rural artisans started getting more loans since they accounted for 70 to 80% of country's workforce back then. And next we can see is last year bank mergers were announced by the Finance Minister Nirmala Sitharaman. So it was announced on August 30, 2019. This merger is approved by the Union Cabinet on 4th March 2020. The merger would be effective from April 1st, 2020. So there were mega mergers of commercial banks last year, which was declared last year by the Finance Minister. You can see the chart here. So Punjab National Bank, Oriental Bank of Commerce, and United Bank, these 3 banks were merged to form the Punjab National Bank. And secondly, Canara Bank and Syndicate Bank was merged to form the Canara Bank. So after merger, PNB became the second largest public sector bank in India. So which is the first largest? Which is the largest one? That is SBI. SBI is the largest commercial bank, public sector, and second is Punjab National Bank after merger of these 3 banks. And the third is Bank of Baroda. Third largest is Bank of Baroda after its merger with Vijaya Bank and Dena Bank. So Baroda Bank was merged with Vijaya and Dena. So after this merger, Baroda Bank became the third largest public sector bank in India. And the fourth largest, as we can see here, is Canara Bank after its merger with Syndicate Bank. And the fifth largest bank is Union Bank of India after amalgamating with Andhra Bank and Corporation Bank of India. So Andhra Bank and Corporation Bank was merged to form Union Bank of India. These three banks were merged, which became the fifth largest public sector bank. And next, Indian Bank and Allahabad Bank were merged to form Indian Bank, which became the seventh largest. And by the way, sixth largest is Bank of India. This is the sixth largest commercial bank of India. And guys, please memorize this chart, because this will also be very important from current affairs perspective. And so we have come to the end of this video, and thank you very much for watching this video till the end. And guys, please like, share and subscribe to our channel and motivate us to produce more of such videos. And part 2 of this video will be uploaded very soon, in which we'll discuss about banking structure and RBI. Until then, stay home, stay safe and stay healthy. Bye bye.